Hey everyone, and thanks for jumping back into the equityverse. Today, we're going to talk about the S&P 500 bear markets. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Links in the description below. Let's go ahead and jump in. So we talked plenty about the S&P 500 bear market. We've talked about how the average length of a bear market that does not include a recession is about 9 months, which would have been essentially back to October of last year. But including a recession, it can go more like a year and a half. And what I want to do again is just sort of compare the current bear market in the context of history. Now, of course, I will always say the important caveat is that there's no guarantee that this bear market has to put in a lower low. And if it does not, then it means the bear market would have ended back in 2022. However, with that said, I'm of the opinion that there is a lot of weakness in a lot of the markets, and there will be a lot of weakness very likely over the coming months. And so my general expectation is that we should still consider this a potential bear market. If you compare this bear market to the context of various bear markets in history, we can sort of isolate the ones that it compares the most similarly to. One of them, of course, that we talked about before is the dot-com crash. Or sorry, this is the financial crisis, the dot-com crash right here from 2000 to 2002. This is actually around the time when it really started to roll over and go into that recession. Remember, this is what marked the recession for the dot-com crash. This low over here, I think, was more likely related to geopolitical matters. But this was actually the recession when you sort of look back at when the recession actually occurred. So if we are, in fact, going into recession within the next few months, and this is the low, I think that would correspond to something like that. So I do think it's worthwhile to compare it to the dot-com crash. But another one that's important to compare it to that isn't necessarily as gloomy is the 1946 to 1949 bear market, also coming off a period of high inflation where you sort of just continue to come back down to the prior low and then eventually put in a slightly lower low. But that occurred a full year later or so after the low that would have come next. So this is what a soft landing, I think, would look like, where the market just sort of scrapes the lows over the course of approximately 3 years. So far, we're clearly already, well over a year into this. And within about 2 or 3 more months, you could argue we'd be about a year and a half into the bear market or into a potential soft landing. Now, there's also another period from 73 to 74, which is also coming out of a period of high inflation, or it was in a period of high inflation, that is more similar to a hard landing. And again, if it's going to follow that route, then that's also around the time where it would really start to come back in, back to the downside. What's interesting is no matter whether you compare this to the hard landing of 73 to 74, whether you compare it to the soft landing of 46 to 49, or whether you compare it to the dot-com crash, in all cases, this leg right here was a pretty typical, or you can see in all 3 prior bear markets, this is the time frame as measured from the peak when those bear markets actually continued on down. Okay, in all 3 cases, and it would have occurred over the next month or two, at least, before maybe seeing another slight move back up in the up direction for a month or something. But I think this is an important thing to consider. Now, we can always talk about various bear markets and how they compare. There's actually another couple interesting ones. Here's the one from 1968 to 1970, and you can kind of see where that is right now. So if we were to follow something like that one, it would mean sort of holding these levels for about another month or so before ultimately having what would be more so considered a hard landing. But rather than compare every single hard landing scenario, soft landing scenario, why don't we just take a look at the extremes of both the extremes of the context of prior bear markets, and you can see that despite the rally that the S&P 500 has had over the last several months, we're still well within, maybe not well within it, but we're still within the confines of prior bear markets, right? As close as we've come to sort of breaking above this line, we haven't done it yet. Now, it doesn't mean we can't, but it does show you that the bear market still is a relatively normal bear market, and it hasn't broken out of the confines of historical bear markets. And if it's going to go put in a new low, it seems like right around now is, at least over the next few weeks, we should start to see some type of a move down into those lower levels. If we don't, and we break back up to the upside in a more sustained way, then that would give more, more credence to the idea that this is the low. But I still do think that we need to be cautious as we sort of stare into into a potential recession, courtesy of the Federal Reserve and their quest to bring down inflation. And so that is, I think, what we need to continue to monitor over the next few months and see ultimately where we end up. So if the S&P does continue to roll over here, I suppose the area to watch, first of all, would be around 3,500. That's where we came in last time. Below that would be things like, 3,400, which was the 2020 high just before sort of the meltdown that we had. And then below that, I mean, obviously we can go take a look at those levels if we get there. But it does seem like right now for the equity market we're at a very important juncture. And it's also happening to correspond to a pretty important meeting this coming week with the Federal Reserve, right? We have the FOMC in just a few days where we're going to see if Powell has meant what he has said for over the last year. Markets are now suggesting that we're going to see rate cuts relatively soon. However, I think Powell's going to push back on this idea and ultimately, continue quantitative tightening and also potentially raising interest rates to 5%. I think that's the base case. That has been my base case for a long time, and I'm going to stick with that story, right? Another 25 basis point rate hike to get us to about 5% for the Fed funds rate. And if he does push back on it, right, if it's a 25 basis point rate hike with a very hawkish tone, then I think that could set the stage for the next leg lower on equities as they then have to reprice in higher for longer, which it seems like recently they've sort of not priced in anymore. And what's also interesting is despite the fact that markets have now decided not to price that aspect in and they're considering rate cuts, it still hasn't led to sort of the equity market going anywhere. So if all of a sudden higher for longer gets priced back in, then I think that could sort of be the catalyst for equities to continue on in their bear market as market participants just sort of finally accept that the Federal Reserve is going to do enough damage to push us into a recession. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out Into the Cryptoverse Premium at intothecryptoverse.com. We are running a sale right now, so check that out. Links in the description below. I'll see you guys next time. Bye.